In this video, we'll show you 3 tech-related companies that are positioned to benefit from some of the biggest long-term trends shaping the global economy and why they could become outstanding investments for patient investors. These businesses dominate critical parts of the technology ecosystem, possess durable competitive advantages that are extremely difficult to replicate, and continue building the infrastructure that could power innovation for many years to come. The first company is Taiwan Semiconductor, ticker symbol TSM. When most people think about technology investing, they immediately picture flashy consumer products or software companies. But the reality is that none of those products exist without one incredibly important business operating behind the scenes. Every advanced processor, artificial intelligence accelerator, smartphone chip, high-performance computing processor, and countless other semiconductor products must first be manufactured before they ever reach customers. That is exactly where Taiwan Semiconductor comes in. Taiwan Semiconductor is not simply another chip company. It is the world's largest dedicated semiconductor foundry, manufacturing, packaging, and testing chips for many of the world's most advanced technology products. Its customers rely on it because building cutting-edge semiconductor manufacturing facilities is one of the most expensive engineering challenges on the planet. It requires decades of research, unmatched technical expertise, thousands of highly specialized engineers, and capital investments measured in tens of billions of dollars. Those barriers have created one of the strongest competitive advantages in the entire technology industry. For long-term investors, this matters because the world is becoming increasingly dependent on semiconductors. Artificial intelligence, cloud computing, autonomous vehicles, industrial automation, medical equipment, consumer electronics, telecommunications. Virtually every major technology trend depends on increasingly powerful chips, and someone has to manufacture them. Taiwan Semiconductor sits at the very center of that entire ecosystem. Instead of betting on just one technology trend, investors are effectively gaining exposure to many of them simultaneously. That diversification inside a single business is one of the reasons many investors view Taiwan Semiconductor as one of the most strategically important companies in the world. But there is another reason why this company continues attracting so much attention. The future of artificial intelligence is no longer just about designing faster processors. It is also about how those processors are assembled. One area where Taiwan Semiconductor has developed a tremendous competitive advantage is advanced packaging. Many investors focus entirely on chip manufacturing while overlooking the packaging process that allows today's powerful AI systems to function. Modern AI accelerators require processors to communicate with massive amounts of high-bandwidth memory at extraordinary speeds. Without advanced packaging, those processors simply cannot deliver the performance needed for today's demanding AI workloads. Taiwan Semiconductor dominates this area through its industry-leading chip-on-wafer-on-substrate technology, better known as CoWoS. This technology allows processors and memory to be connected with extremely high bandwidth while maintaining efficiency and performance. In simple terms, CoWoS helps transform individual chips into complete AI computing systems. That capability has become incredibly valuable as demand for artificial intelligence infrastructure continues growing around the world. One interesting aspect of this business is that demand for its advanced packaging has become so strong that available capacity remains extremely limited. Scarcity often creates pricing power. When customers desperately need production capacity but supply remains constrained, manufacturers are often able to negotiate favorable pricing and long-term agreements. Although limited capacity could eventually encourage competing technologies to emerge, Taiwan Semiconductor currently maintains one of the strongest competitive positions in advanced packaging. That leadership gives investors another reason to believe the company can continue benefiting from the AI investment cycle. Now let's look at the financial picture. Taiwan Semiconductor generated approximately $120.34 billion in revenue. Adjusted earnings per share reached $10.39. The stock currently trades around a price-to-earnings ratio of approximately 32.64. Analysts also expect earnings per share growth of roughly 48%. Those numbers are impressive on their own, but they become even more meaningful when viewed in the context of the company's long-term opportunity. Many mature businesses struggle to grow earnings in the high single digits. Taiwan Semiconductor is expected to grow substantially faster because demand for advanced chips continues expanding across multiple industries. Artificial intelligence is certainly one driver, but it is far from the only one. Automotive chips continue becoming more sophisticated. Data centers require increasingly powerful processors. Industrial automation keeps expanding. Edge computing continues growing. The Internet of Things keeps adding billions of connected devices. Each of these trends creates additional semiconductor demand. Rather than depending on a single product cycle, Taiwan Semiconductor benefits from multiple secular growth drivers working simultaneously. Another important advantage is scale. Manufacturing advanced semiconductors is incredibly expensive. Each new fabrication facility requires enormous capital expenditures. Companies without sufficient scale often struggle to justify those investments. Taiwan Semiconductor, however, serves an enormous customer base across multiple industries. That allows it to spread development costs across far more production volume than smaller competitors ever could. Scale also strengthens research and development. The more advanced manufacturing technology becomes, the harder it is for newcomers to catch up. This creates a powerful cycle where leadership helps generate more business, more investment, and even stronger leadership over time. Long-term investors often look for companies that become more valuable as they grow. Taiwan Semiconductor appears to fit that description remarkably well. Another reason investors should pay attention is resilience. Technology cycles naturally experience periods of slower demand. Consumer electronics sales fluctuate, economic conditions change, corporate spending rises and falls. Yet semiconductor demand has consistently recovered because digital technology keeps becoming a larger part of everyday life. Every new generation of technology requires more advanced chips than the generation before it. That long-term structural trend has remained remarkably consistent. When evaluating a business for the next decade rather than the next quarter, those structural trends matter much more than temporary headlines. Of course, no investment is perfect. Investors should recognize that valuation always matters. The semiconductor industry can experience periods of volatility, supply constraints can eventually normalize, competition can evolve. Technology never stands still. However, when weighing both the opportunities and the risks, Taiwan Semiconductor continues to stand out because it occupies one of the most important positions within the global technology supply chain. As artificial intelligence continues expanding from training models into enterprise applications, autonomous systems, robotics, healthcare, manufacturing, financial services, and countless other industries, demand for advanced semiconductors should remain a critical component of that growth. And if advanced chips remain essential, companies capable of manufacturing those chips at the highest level should continue playing a central role in the global economy. For investors with a long-time horizon, that combination of market leadership, technological expertise, strong earnings growth expectations, and durable competitive advantages makes Taiwan Semiconductor a company that deserves serious consideration. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second company is NextEra Energy, ticker symbol NEE. At first glance, NextEra Energy may seem like an unusual choice for a list of long-term tech investments. After all, it is an electric utility. But when you take a closer look at where technology is headed over the next decade, you quickly realize that electricity has become one of the most valuable resources in the AI economy. Artificial intelligence is creating an unprecedented surge in electricity demand. Every AI model that gets trained, every chatbot that answers a question, every autonomous system making real-time decisions, every cloud application processing billions of requests. Every one of these technologies runs inside data centers that consume enormous amounts of electricity. As AI adoption accelerates, one of the biggest challenges facing the technology industry is no longer designing faster chips. It is finding enough reliable power to keep those chips running. That is exactly why companies like NextEra Energy have become increasingly important. Technology companies can build the most advanced AI systems in the world, but if they cannot secure long-term electricity supply, those investments cannot generate their full potential. Power has quietly become one of the biggest bottlenecks in artificial intelligence. NextEra sits in a unique position to benefit from that trend. The company operates America's largest electric utility while also being one of the country's biggest energy infrastructure developers. That combination gives it exposure to both regulated utility income and long-term infrastructure expansion. Unlike businesses that depend on consumer spending or changing technology preferences, electricity demand tends to be remarkably stable. Homes need electricity, businesses need electricity, factories need electricity. Now AI data centers are becoming one of the fastest growing electricity consumers anywhere in the world. That creates a completely new layer of long-term demand. One of the reasons investors have become increasingly optimistic about NextEra is that management appears to recognize exactly where this opportunity is heading. Rather than relying on a single source of electricity generation, the company operates a diversified energy portfolio that includes natural gas, renewable energy, and nuclear power. That flexibility matters. The future electrical grid will likely require multiple energy sources working together. Renewable energy continues expanding. Natural gas provides dependable backup generation. Nuclear delivers large amounts of carbon-free baseload electricity around the clock. Companies building massive AI campuses care about reliability just as much as sustainability. They cannot afford unexpected interruptions. That makes diversified utilities especially valuable. Another major reason NextEra stands out is its growing focus on clean energy partnerships with some of the world's largest technology companies. The company has already secured significant clean energy agreements with Google and Meta. These agreements demonstrate that major technology companies are no longer simply purchasing electricity. They are actively seeking strategic energy partners capable of delivering reliable clean power over many years. That trend could become increasingly important as governments, investors, and customers continue placing greater emphasis on sustainability. Companies developing artificial intelligence infrastructure increasingly want their operations powered by cleaner energy sources whenever possible. NextEra is positioning itself directly where those priorities intersect. The company is also investing heavily in its nuclear fleet. That deserves attention because nuclear energy has re-entered the conversation in a very significant way. For years, nuclear was often overlooked in discussions about future energy. Today, the conversation looks very different. Artificial intelligence requires enormous amounts of uninterrupted electricity. Unlike wind or solar generation, nuclear plants provide stable output 24 hours a day. That reliability makes nuclear increasingly attractive for powering data centers that operate every second of every day. By continuing to invest in its existing nuclear assets, NextEra is strengthening its ability to meet future electricity demand while maintaining a lower carbon profile. Perhaps the most interesting development involves the company's planned acquisition of Dominion Energy. If approved by regulators, this transaction would significantly expand NextEra's presence in one of the most strategically important technology regions in the United States. Dominion currently supplies electricity throughout Northern Virginia, home to what many people call Data Center Alley. This region contains one of the highest concentrations of data centers anywhere in the world. As artificial intelligence investment accelerates, demand for electricity across this region continues rising rapidly. Owning a larger footprint in that market could provide NextEra with decades of growth opportunities. The proposed acquisition would also create the world's largest regulated electric utility by market capitalization, serving approximately 10 million utility customers. Scale matters in utilities just as much as it does in technology. Larger utilities often gain operational efficiencies, stronger financing capabilities, and greater flexibility when making long-term infrastructure investments. Although the transaction still requires regulatory approval, investors are paying close attention because of its potential strategic value. Now let's look at the financial side of the business. NextEra Energy generated approximately $27.4 billion in revenue. Adjusted earnings per share came in at $3.71. The stock trades around a price-to-earnings ratio of roughly 21.84. Analysts currently expect earnings per share growth of approximately 8.4%. Those growth expectations may appear more modest than high-growth technology companies. However, investors should remember that utilities operate very differently. They typically generate consistent cash flows supported by regulated operations while steadily expanding earnings over long periods. That stability becomes particularly valuable during periods of economic uncertainty. For many long-term investors, building wealth is not simply about owning the fastest-growing companies. It is about combining growth with resilience. NextEra offers exposure to one of the strongest long-term themes in the market while maintaining characteristics that many investors appreciate during market volatility. Another advantage worth mentioning is visibility. Many businesses struggle because future demand remains uncertain. NextEra faces a very different situation. Electricity demand from AI infrastructure is becoming easier to forecast as technology companies continue announcing massive capital spending plans. New data centers require years of planning. Utilities often negotiate long-term agreements before facilities even begin operating. That gives companies like NextEra unusually strong visibility into future demand growth. As more AI infrastructure comes online over the next decade, electricity demand could continue expanding well beyond historical averages. Very few industries can say they are benefiting from one of the largest technology investment cycles in history, while also operating relatively predictable business models. That combination makes NextEra particularly compelling. Investors often search for businesses that can quietly compound value year after year without constantly chasing the next trend. NextEra appears to be building exactly that kind of foundation. Its combination of regulated utility operations, diversified power generation, clean energy leadership, nuclear investment, and expanding exposure to AI-driven electricity demand creates multiple long-term growth drivers working together. Instead of asking which artificial intelligence software company might dominate 10 years from now, another approach is asking a simpler question. Who will supply the electricity required to power the entire AI economy? NextEra is positioning itself to be one of the answers. That makes it much more than just another utility stock. It is becoming an increasingly important infrastructure company supporting one of the biggest technological transformations of our generation. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final company on the list is Vertiv Holdings, ticker symbol VRT. If you've been following the artificial intelligence boom, you've probably heard plenty about chips, cloud computing, and data centers. But there is another business that often gets overlooked, even though it plays a critical role in keeping AI infrastructure running. That business is Vertiv. Every AI server generates enormous amounts of heat. The more powerful the processors become, the greater the cooling challenge. Without sophisticated cooling systems and reliable power infrastructure, those expensive AI servers cannot operate efficiently. Performance suffers, operating costs rise, and equipment lifespan can be reduced. That means cooling is no longer just a maintenance expense. It has become a mission-critical part of AI infrastructure. Vertiv has built its business around solving exactly this problem. The company designs and manufactures infrastructure technologies that power, cool, protect, and optimize data centers and other mission-critical technology environments. In many ways, Vertiv sells the systems that allow the digital economy to function behind the scenes. The remarkable thing about this opportunity is that artificial intelligence is making every new generation of data centers significantly more demanding. Traditional cloud workloads already required substantial cooling capacity. AI clusters require considerably more. High-performance AI servers consume dramatically more electricity than conventional servers. More electricity means more heat. More heat requires more sophisticated cooling. As AI deployments continue expanding worldwide, demand for advanced cooling infrastructure should continue growing alongside them. This is one reason investors have become increasingly interested in Vertiv. The company is no longer viewed as simply a cooling equipment manufacturer. Management has been steadily transforming the business into a much broader provider of integrated cooling and power solutions. That strategic shift is important. Instead of selling individual products, Vertiv increasingly provides comprehensive infrastructure solutions that customers can deploy across entire facilities. Providing integrated systems often creates stronger customer relationships. It can also increase switching costs because customers prefer infrastructure components that work seamlessly together. Once critical infrastructure has been installed inside a major data center, customers are generally reluctant to replace proven systems unless absolutely necessary. That creates another layer of competitive advantage. Perhaps the strongest evidence supporting Vertiv's long-term opportunity came earlier this year when the company reported a backlog of approximately $15 billion. Think about what that number represents. Customers have already committed to purchasing billions of dollars worth of infrastructure. That backlog was driven primarily by demand related to artificial intelligence infrastructure. For long-term investors, backlog matters because it provides visibility into future revenue. It suggests demand remains considerably stronger than current production. Strong backlog also indicates that customers are making long-term infrastructure investments rather than temporary purchases. Building AI data centers requires years of planning. Companies ordering infrastructure today are preparing for future computing capacity. That creates confidence that demand extends well beyond the current quarter. Another fascinating development involves Vertiv's continued expansion beyond physical equipment. In June, the company announced a digital twin capability for its SmartRun platform integrated into NVIDIA's AI data center simulation platform. This represents an important evolution in how data centers are designed. Imagine constructing a billion-dollar AI facility. Finding design problems after construction has already begun could become incredibly expensive. Digital twin technology allows engineers to build an accurate virtual model before equipment is installed. They can test layouts, simulate performance, identify potential problems, optimize cooling, improve power distribution, and make adjustments before construction costs escalate. That dramatically improves planning while reducing risk. This capability signals something even more important. Vertiv wants to become an integrated technology partner throughout the entire data center design process, not simply an equipment supplier delivering hardware after construction decisions have already been made. That expands the company's role within customer projects. The earlier a company becomes involved in infrastructure planning, the more opportunities it has to provide additional products and services. Now let's examine the financial picture. Vertiv generated approximately $10.23 billion in revenue. Adjusted earnings per share reached $4.20. The stock currently trades around a price-to-earnings ratio of approximately 79.85. Analysts expect earnings per share growth of roughly 54.5%. At first glance, some investors may immediately focus on the higher valuation. That is understandable. A premium valuation naturally raises expectations. However, premium businesses often trade at premium multiples when investors believe future earnings growth can justify today's price. The key question is whether the long-term opportunity supports those expectations. Artificial intelligence infrastructure spending suggests that demand could remain exceptionally strong for years. Technology companies continue investing hundreds of billions of dollars into AI infrastructure. Governments are investing. Enterprises are investing. Cloud providers continue expanding capacity. Every new AI facility requires reliable electrical infrastructure, thermal management, monitoring systems, and integrated engineering solutions. Vertiv participates directly in those investments. Another factor supporting the long-term thesis is that AI infrastructure is becoming increasingly complex. Cooling next-generation AI systems is substantially more challenging than cooling traditional enterprise servers. Higher rack densities require more advanced thermal management. Power distribution must become increasingly sophisticated. Infrastructure reliability becomes even more important because downtime carries enormous financial consequences. As these technical challenges become more demanding, customers often prefer working with experienced providers capable of delivering integrated solutions. That trend could strengthen Vertiv's competitive positioning over time. Long-term investors should also appreciate the recurring nature of many infrastructure relationships. Once equipment has been installed, customers frequently require maintenance, upgrades, replacement components, monitoring services, and expansion projects. That creates opportunities beyond the initial sale. As global AI infrastructure continues expanding, existing customer relationships may become increasingly valuable. Looking beyond artificial intelligence, the broader digital economy continues generating demand for reliable infrastructure. Cloud computing, telecommunications, healthcare, financial services, industrial automation, edge computing, all of these industries rely on highly reliable technology environments. Vertiv's expertise extends across these mission-critical applications. That diversification provides another layer of resilience. No investment comes without risks. A premium valuation leaves less room for disappointment. Project timing can fluctuate. Capital spending cycles can change. Competition can evolve. Investors should always evaluate valuation alongside long-term business quality. But when you combine Vertiv's expanding product portfolio, integrated infrastructure strategy, growing software capabilities, enormous backlog, and direct exposure to one of the largest AI infrastructure build-outs in history, it becomes easier to understand why so many long-term investors continue paying close attention. When you step back and look at all three companies together, a powerful pattern begins to emerge. Taiwan Semiconductor manufactures the advanced chips that make artificial intelligence possible. NextEra Energy supplies the reliable electricity needed to keep that computing infrastructure running. Vertiv provides the cooling and power infrastructure that allows those massive AI data centers to operate safely and efficiently. Each business occupies a different layer of the same long-term technology ecosystem. Instead of competing against one another, they complement each other. That is one reason this combination stands out for investors thinking 10 years ahead instead of 10 weeks ahead. Technology trends will undoubtedly evolve. New applications will emerge. Consumer preferences will change. But the need for advanced semiconductors, reliable electricity, and mission-critical infrastructure appears likely to remain essential for many years. Those are exactly the kinds of durable businesses many successful long-term investors look for. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd like to hear from you. Which of these three companies do you believe has the strongest long-term competitive advantage over the next decade? Taiwan Semiconductor, NextEra Energy, or Vertiv Holdings? And which one would you be most comfortable buying and holding through market volatility? Let us know your thoughts in the comments below because I'd love to hear your perspective. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.